What's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain is you go back a year, so kind of this time last year, we all remember headline, supply chain's broken down, the shelves are bare. So all true, that was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, well, or tripled the orders. They said, well, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that with the Fed tightening rates into weakness. The Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve, and they're focused on the unemployment rate, which is not a good measure of what's going on in the labor force. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of it. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. There are 2 huge fallacies in that narrative. The first one is, who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger: is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets, where you ended up losing everything, but for a couple of days or weeks even, it's the bottom's in, you buy stocks, etc. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment, and we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked, but it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later, but that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen. But there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference, there are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors. Everything I just described is playing out, and there's data to back it up, not just an inverted Treasury yield curve, which is interesting. Well, 210 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. I call the Treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future it's like we're betting on what an overnight rate is going to be 2 years from now. So okay, long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping, just because time value of money and uncertainty, et cetera. If I lend to you for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis. because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown and, turning on CNBC and like watching pets.com, the sock puppet and all these things, they're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had, kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized in, they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession, but that's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day, no recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. If everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic, and a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, 2 different things, but they could converge. Got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? So I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it, people acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in fall, late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve is inverted, the narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally, and the stock market's, recovering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for 2 reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, it doesn't mean the Fed's going to cut. That is the message, but it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DV01, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when you at higher rates, the DV01 is lower, and at lower rates, the DV01 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. Much higher interest rates, a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar. And that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DV01, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern. The dollar's getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. But this is a conundrum for a lot of people because they look at it, the US objectively, okay, our debt to GDP ratio is over 130%, highest in US history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the US economic growth is incredibly weak. So we've got sky high debt to GDP ratio. People talk unemployment close to an all-time low. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. So if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So I forgot the deficit's out of control, and your trade deficit's out of control. So what's not to like? You look at all that and say, what, are you kidding me? I mean, get me out of the dollar, go get anything else. Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. I'm like a 27 or whatever, a 28 maybe year old lawyer, but I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie. It's called Rollover. And it's, again, 1980. It's basically about the collapse of confidence in the US dollar. And basically the idea was, remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, hey, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course, he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. But it presupposes that you can always borrow in the Eurodollar market. In other words, that closed circuit analogy is correct, provided the big banks are willing to lend to each other. So if my example, if UBS was selling the gold and to the Arabs and they got the money and they put it back in Citibank Nassau, it's all good. But what happens if that money supply, now I'm talking about Eurodollars, actually shrank? And that is a heart attack in the global financial system. So now, we're like, well, okay, what's going on? And believe it or not, there's a global dollar shortage. And when you say that, people say, wait a second, you kidding me? The Fed printed, the Fed's balance sheet in 2008 at the start of the global financial crisis was $800 billion. It was $4.5 trillion by the time we got to the end of the taper in November 2014. Then, okay, yelling a little bit, but mostly Powell got it. They started quantitative tightening. They got it back down to around 3.5 trillion by the time COVID came along. And then boom, it's up to 7.5 trillion, might have gone higher than that. And that's M0. M1 was exploding even more. So how could there be a dollar shortage? And that has a two-part answer. One is the money printing, at least M0, is irrelevant. It just doesn't matter. Because how do they print the money? Well, the Fed buys securities from the primary dealers. And I was, after I left Citibank, I joined one of the biggest primary dealers, and I was there for 10 years. So I had a front row seat. That was back in the days when the Fed was actually tough on people. But my point is, I was a counselor, a primary dealer. We talked to the Fed every day. And so the primary dealers are the ones where the Fed open market desk, the New York Fed does monetary policy. They buy, so they call up Goldman Sachs or Citi or whoever. So you offer me, 5-year notes or 2-year notes or whatever. Here's a price done. The banks send the securities to the Fed, and the Fed pays for it with money that comes out of thin air. But here's the part that matters. What do the banks do with that money? They give it back to the Fed. in the form of excess reserves. It's the bank deposit at the Fed, in effect.
Mhm.
So that money never went anywhere. It was created, it is on the balance sheet, but it all went to the asset side, which were securities, and it never went into the economy. So where does the money come from that runs the economy? If you or I want to go shopping, well, it comes from the commercial banks. It comes from M1. Yeah, there is a multiplier, but that's in M1 and M2, which is created by the banks at will. And the Fed, those commercial banks have as much printing power as the Fed. They just do it differently by lending money or buying securities and paying for them with money that they create. So and that never happened. It happened to some extent, but not nearly to the extent that what the Fed was doing with M0. So M0 didn't really matter. I mean, I hate to break it to people. Commercial banks do matter. Euro dollars do matter. That's how we run the system. People say, well, how can you have a dollar shortage with trillions of dollars of new money? You have $1 quadrillion of derivatives in the banking system as a whole. So that slice, whether it's the 7 trillion of M0 or a larger number, perhaps 24 trillion of M1, that has to support $1 quadrillion of derivatives. And by the way, for those who don't know, a quadrillion is 1,000 trillion. That's what a quadrillion is. So now it's not dollar for dollar. Jamie Dimon would say, well, who cares? Just put up a little collateral. But you have to put up some collateral. And then you get into the collateral issues. Like, well, what's good collateral? The answer is, and this is what the banks are saying to each other. And this goes back to my conversation with Walter Wriston and the movie Rollover and all that. The banks are, and in fact, what happened in 2008, the banks are looking at each other saying, I don't want your corporates. I don't want your mortgages. I don't even want your 10-year notes. Give me at a stretch, I'll take a 2-year note with a haircut, or what I really want are 30, 60, 90-day bills. I want treasury bills. And so you got to go out and get the treasury bills, and they're dollar denominated, which means you need dollars. So if you're Credit Suisse or Barclays or Hong Kong, Shanghai, or Deutsche Bank, you don't live in a country that prints dollars. The US does, but the European Central Bank doesn't. So there's this enormous demand for dollars, not because they love the dollar, but because they need to buy dollar-denominated collateral of a very high quality in order to pledge as collateral to support the quadrillion derivatives position, and plus any other trading they're doing. And so that's the clue. That's the secret that unlocks, or the key that unlocks the whole mystery, which is, it doesn't matter what the debt, for now anyway, it doesn't matter what the debt to GDP ratio is, the deficit is, the labor force participation rate, the weak, none of that matters. What's going on, not in M0, but in M1 and Euro dollars in particular, is a mad scramble for dollar-based, high quality dollar-based collateral. And that's what's driving the dollar. The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. Lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. So a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, like, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I mean, I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But, when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and, for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you are based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failure is manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element.